Good morning. It's Monday once again, May the 11th. Here's what's on our agenda. Oil and yields climb again as President Trump rejects Iran's latest offer. Can Trump's visit to China this week break the deadlock over the Middle East? And gilt markets are watching Prime Minister Starmer today. Can his speech save his job?
OK, let's talk about these markets. Monday morning, no deal over the weekend on Iran. Brent crude is up by nearly 4%. The tech trade does not care. The Kospi up 4.4%. The semiconductor story rockets on. We'll talk about that in just a moment. Where does that leave Europe? Bit meh this morning. Europe, nothing really to see here. Euro Stoxx 50 futures up by 0.1%. We have a lot to talk about. The countdown to the opening trade starts right now.
So another Monday and another move back to square one, essentially, in terms of any optimism there had been about a potential deal between the US and Iran. President Trump saying that the Iranian offer is, quote, totally unacceptable. So we go back to the timelines in terms of what the global impact is of a continued closure of the Strait of Hormuz. I thought it was really interesting to hear from the Saudi Aramco CEO over the weekend saying that unless the Strait of Hormuz opens in the next couple of weeks, if it remains closed for the next couple of weeks, you could see supply disruption not unravelling until 2027. This becomes a 2027 story if this disruption continues for another couple of weeks. That's the CEO of Saudi Aramco.
And, of course, we've seen, therefore, markets responding. Oil prices are higher, up by 4%. Gas prices in Europe are higher. Yields are going higher. So we'll watch for that in 25 minutes or so for Europe and for the gilt market open, and added complexity there as well. The dollar is gaining. So there is some market response to this story. But it does seem as if the Asia session, as you've been referencing, very preoccupied with the tech trade and the Kospi. Another leg higher there.
Amazing. It just continues to just move high. Another near 5% session being delivered out of Korea. How much further does this go? You look at what is happening in markets right now in terms of the put-call ratio. Dan and I were kicking around some charts earlier on. Put-call ratio really extended right now in terms of people buying calls in the United States. You take a look at what is happening in terms of breadth. You don't see this kind of narrowness of a market. You haven't seen this since basically 1999. 2008 is the last time we saw the put-call ratio this out of whack.
It's exactly what I was going to say. Any 2008 reference just automatically takes your attention, doesn't it? And that, exactly, the call skew, the highest since 2008. That was in one of those charts we were looking at earlier.
And the Kospi, again, firing on all cylinders, to your point. And Morgan Stanley, JP Morgan and Goldman Sachs. JP Morgan coming out now with, on its bullish scenario, 10,000 for the Kospi. The Kospi remains king. The semiconductor trade story on Friday was very strong in the US as well. Double-digit gains for some of those players, including the likes of Intel. And to your point, the optimism in terms of that puts to calls ratio, the investor optimism remains.
On the Kospi, we've seen 10 one-day gains of more than 4% just this year. And on the Nasdaq, we've seen none. I mean, it's not like the Nasdaq's unaffected by all the enthusiasm around AI, but it's just that the market's attention is so skewed towards what's going on in Asia and these memory stocks.
So equity markets look at tech, bond markets are looking at the oil trade, which I think is fascinating as well. And you take a look at what is happening in China right now, some really interesting data coming out as well. Its PPI, its inflation data beginning to push up, being driven by what is happening in terms of the global shortage story. That is interesting in the light of what we're about to get later on this week in terms of this meeting between Xi and Trump. Iran is going to be kind of on the agenda there. What incentive do the Chinese have, given this kind of data, to try and help resolve the crisis? Or are they happy to see the US suffer as a result of what is happening in the Straits of Hormuz?
2.8% was PPI versus the previous month of 0.5%. So China as a deflationary story for the global economy seems to be... That is firmly in question. China is playing these major roles in terms of reducing its imports of oil, and that has created something of a buffer for the oil markets, and it's also provided that slightly deflationary impetus to the global economy. But that seems to be eroding as well. So we head up to that meeting, maybe some deals, maybe a new board of trade and commerce between the two sides that they may nail down. But you're going to get more deals in terms of aircraft, in terms of soybeans, the easy stuff that China can give the US.
What does the market want out of this meeting? Does it want a deal? Does it want progress? Or is it happy just with, we'll park this one and put it to one side? What it doesn't want is a breakdown in the relationship, a further factor to kind of add to the downside and kind of further fracturing of the global economy. That's what it doesn't want. So
yes.
Just sort of status quo would be good.
Right, yeah. How much of this is about optics? How much is it about the numbers and the deals and the things around soybeans and aircraft? And how much is it about how well are these two men able to, if not improve the relationship, at least not have it deteriorate any further from here.
Yeah.
And what kind of role can China play in Iran? Back to where we started the conversation. If China is able to lean on Iran, it is an importer of Iranian energy, of course. We know that there are supplies of weapons going to Iran as well. So that is going to be something that no doubt will be not far from
I would just look to China's role in Russia and just the pressure that China's come under and has not buckled. It's to maintain that relationship and that support for Russia. The idea that China is going to reverse in terms of its support for Iran on the back of this visit seems pretty distinctly unlikely to me. But we'll see if we get status quo when it comes to UK politics, because a major speech for the Prime Minister here as well today.
Yeah, absolutely. Yes, today Keir Starmer is going to speak. He's aiming to stall any immediate challenge to his job. Is that the way that's the way some of our colleagues have been describing it? It looks as if he's going to put Europe into the speech today. So taking the UK closer to Europe, that's going to be an interesting dynamic to watch. Other things we've been notified are going to be in the speech, think references to growth and defence and to energy. Interesting on defence, all of the news flow around Gordon Brown at the weekend, but that's perhaps a conversation for another time. Will any of this be enough to stop Angela Rayner and Wes Streeting, who are waiting in the wings and could be ready to launch a leadership challenge? Is this a longer-term story around Andy Burnham, who is somebody who's not in Parliament right now? All of this is to say that the gilt market's going to be a little nervous and anxious on a day that we've got gilt yields around the world, on treasuries rising, on JGBs rising as a result of inflation worries.
If Wes Streeting becomes the next Prime Minister, how does the gilt market react to that? How does the gilt market react to Angela Rayner? Burnham feels like a more distant prospect at the moment. So do you price that out? Do you price that sharp move to the left out in terms of what you position for in gilts?
It was quite a contrast in the messaging we're being told that Starmer's going to give us today and what we heard from Angela Rayner over the weekend. She put out this lengthy statement. It was very domestic in focus, very cost of living in focus. Yeah. And maybe Starmer's going to try and join the dots between those two, but that's just, flexing her left-of-party credentials. Wes Streeting perhaps not seen quite so left leaning,
yeah, precisely.
But therefore perhaps less likely.
If there is a leadership challenge before Burnham is a member of Parliament, do you park the extreme move to the left? If you who wins out of Rayner and Streeting, were they to be? There could be other candidates, but who wins there?
Because Burnham could be a months-long process.
Precisely.
To get to this point where he could really challenge the Prime Minister.
So how do you price this, just from a kind of, what are the range of outcomes? Is Streeting more likely? And if so, does that get priced in this morning?
It's interesting that the pound doesn't stand out as very different to other currencies this morning. Yes, it's down against the dollar, but so is the euro. Looking at euro against sterling, there's not a huge amount of movement in there. And I wonder if the market is asking itself the same question. We don't really know much more about who follows and when than we did on Friday.
Our team is saying this is easily the most consequential speech of the Prime Minister's career later today.
I'm sure it probably is. But how extreme do you need to go to provide something that is still? It's always the future. Here's the future. What have you actually done? And are we at the point where everybody goes, well, you haven't done anything, so do we believe what you say about the future? I don't know. It feels like change is afoot at the moment. When? I don't know. Anyway, plenty to discuss. Laureline Renaud-Chatelain is going to be joining us very, very shortly. Pictet Wealth Management will talk about the market's fixed income lead there. Haig Bathgate, Callanish Capital CEO, joining us later. Emily Ashford, Standard Chartered Energy Research Head, is going to be joining us. That'll be an interesting conversation. We're going to talk about where the Brent price goes, what's happening with diesel, the relationship with inflation, all of that on deck. OK, let's look ahead to what else we are watching throughout this week then. Later today, US Treasury Secretary Scott Bessent will be in Japan, as the intervention questions remain, of course, for the Japanese authorities. On Tuesday, Germany's ZEW survey, and we're going to get US CPI, consumer price inflation. Of course, the jobs numbers were strong on Friday, non-farm payrolls. On Wednesday, both IEA and OPEC monthly oil market reports come out, so some more details in terms of what we're seeing across the oil markets. And Euro area first quarter GDP and US producer prices come out later on Wednesday. On Thursday, Trump is expected, as we've had confirmed now from the Chinese side, to visit China, and we will get UK first quarter GDP as well. And on Friday, Jerome Powell's term as Fed chair ends. And this is part of our big take today, with some
beautiful photography, but also the legacy question remaining for Jay Powell.
Yeah.
Central bank independence.
Yeah. Does your mind go to transitory and to the inflation overshoot and the fact that inflation's been, I think, over target for 5 years? Or do you think about Fed independence and that incredible statement in January when he came out with that video just a couple of minutes long, basically saying that the DOJ was taking legal action against the Fed and it was politically motivated and standing up to Fed independence? So there's a lot to think about when his term as a chair comes to an end.
Will his check come to an end just as US inflation really rockets higher as well? And is that something we're about to see happen? If you look at the diesel price comparison, look at diesel in the States. It's sharply higher. Normally, that translates into a sharp uptick in CPI because basically you move stuff around America with diesel.
How quickly is that relationship between Trump and Kevin Walsh going to break down?
So that was where I was going with this, which is basically he's leaving as inflation rockets higher. Kevin Walsh comes in, and what do you do with that? You can't cut rates in that kind of environment. What else do you need to know this Monday morning? Repatriation flights for passengers aboard the MV Hondius cruise ship following a deadly Hantavirus outbreak are underway. Flights have departed for Spain, France, Canada and the Netherlands, with more scheduled to Turkey, the UK, Ireland and the United States. The World Health Organization recommends passengers return home and undergo monitoring for 42 days due to the virus's incubation period. More than 40 nations will meet later to discuss a possible European-led task force to escort ships through the Straits of Hormuz once there is a stable ceasefire. The countries are expected to offer demining, escorting and air policing capabilities as part of a defensive naval mission led by the UK and France. And Alphabet is on the brink of overtaking AI chip giant Nvidia as the world's largest company. The gap between the two has narrowed considerably over the last 6 months. Alphabet shares have been on a tear this year, including a 34% gain in April, its best month since 2004. The Google parent, closed Friday with a market capitalization of $4.8 trillion. Nvidia ended the week with a rally that put it at $5.2 trillion. That doesn't sound like a sort of big amount, but actually that's quite a lot of money still separating these two companies. So it'd be interesting to see how fast that gap actually really closes. Yeah,
we'll watch that evolution within the US tech space as well as the US versus Korea right now. Coming up on the programme then, the oil story front and centre. Aramco's first quarter profit jumps 26% year on year, but the CEO warning of a long disruption to oil markets from the closure of the Strait of Hormuz, of course. Plus, a conversation with the Lithuanian foreign minister. We'll get his view on NATO cooperation, defence spending and much more. Up next, we'll be joined by Sri Kochagovindan, senior research economist at Aberdeen. What does the closure of the Strait, which is ongoing, of course, continue to mean for the global economy? If you have questions and you want to get involved in these conversations, IB plus BBTV Go, that is the function to use on the Bloomberg terminal. It's Monday the 11th. This is Bloomberg. Welcome back. This is the opening trade. Monday morning, and the futures picture looks pretty flat, actually, for European stocks. US futures, incidentally, also looking pretty flat this morning. This despite movement in other markets, oil prices higher, for example, and yields moving higher on inflation fears. Now, President Trump and Iran rejected each other's latest peace proposals to end the 10-week conflict. In a social media post, President Trump called Tehran's response to the US's peace plan totally unacceptable. According to the Wall Street Journal, Iran had proposed diluting some of its highly enriched uranium and having the rest sent to a third country, but it also ruled out dismantling its nuclear facilities. Let's bring in Bloomberg Horizon's Middle East and Africa anchor Jumana Basechi, who can round up where we are this Monday then, Jumana. And so we were going into the weekend waiting for the Iranian response. We got it. It's not, in the US administration's view, good enough. So where does that leave us?
Yeah, that's right. And then certainly a different sentiment prevailing this morning from where we were a week ago when those media reports emerged suggesting that the two sides were actually close to an agreement on that one-page memo the U.S. had proposed. Now, we did get the Iranian response. President Trump, as characteristic to him, putting up a Truth Social post overnight suggesting that it was totally unacceptable. And he says that he doesn't like their response at all. Now, there hasn't been an official readout of what was in the Iranian counterproposal proposal, but from what we can gather from Iranian state media, from Tasnim, and obviously this is an outlet that is very closely associated to IRGC, they're sticking to this two-phase plan. The first phase would entail the gradual reopening of the straits, but only in exchange for a lifting of sanctions, an unfreezing of assets, and a de-escalation of tensions in Lebanon as well. So again, trying to bring Lebanon back into the equation. Only after that will they be happy to start talking about the nuclear file. Now, from President Trump's perspective, he has maintained, and this is something that various U.S. officials have said throughout the course of this war, you can't separate the two issues, and you can't make the Strait of Hormuz become an issue in itself and then defer the nuclear file to later. And on the nuclear file, as you said, Wall Street Journal reporting that one of the other reservations that Iran had was to do with the U.S. demands to fully dismantle their enrichment sites. That is not something that they are willing to subscribe to, in addition to different timeframes being agreed about the level of uranium suspension, the time frame over that period of suspension, and then also the fate of that enriched uranium stockpile. So still, the same issues that we were talking about around the Islamabad talks and even before the war started, doesn't appear to be a lot of progress. At the same time, President Trump saying yesterday that 70% of the military objectives have been achieved, which you could read as another 30% still yet to be achieved from another potential flaring up of hostilities. Now, there was a suggestion that maybe Trump would look to wrap things up before this high-level stake summit between Trump and Xi that's happening this week. And so the expectation is if we once again do go down the path of hostilities, you'd probably get through that meeting first, maybe give one last push for diplomacy. And indeed, the Israeli Prime Minister, in an interview with CBS yesterday, said that the war is not over. There's more work to do. So certainly still a possibility, once again, that we may see kinetic warfare.
Yep. And that is definitely not priced right now, certainly into a lot of asset prices. Jumana, thank you very much indeed. Jumana Basechi joining us from Dubai on the latest out of the Gulf. Let's carry on the conversation. Shri Kochagovadan, Senior Research Economist at Aberdeen Investments, joining us around the table. Good morning.
Good morning.
The Aramco CEO over the weekend was talking about the fact you could see chaos in energy markets into 2027. We don't know what's going to happen in the Gulf. How much variability is in there in your inflation outlook right now? How hard is it to pin down what inflation is going to do next?
It is incredibly difficult. It all depends on when the strait actually reopens. That is quite critical, not just for oil, but for supply chains in general.
Yeah.
And that's exactly what the CEO is saying from Saudi Aramco. So right now what we're seeing is the beginnings of inflation feeding through from energy prices. So we're starting to see headline inflation picking up across different countries. Within core, I'd say, it's just in certain items such as fuel products rather than a broad spillover. But we are going to start to see the impact of the other products that are being constrained, whether it's helium or naphtha, which we've heard a lot about in the last 3 months or so. And I think that this takes time to filter into core goods. So exactly as he says, it's more, I wouldn't say we have to wait as far as 2027, actually. I'd say later on this year, you could start to see core goods inflation picking up because of these disruptions and because of the fact that, we have to stop the strait has to reopen. That takes time. It needs demining. So the longer we wait,
how quickly does that happen? Once it starts to kick in, how quickly does that process unfold?
It could be at least another 4 to 6 weeks, unfortunately, for everything to start normalizing, because there needs to be a demining process, there needs to be, confidence, there are insurance costs to consider. So it does take time to reopen. And on top of that, if we think about infrastructure that has been damaged, that can take a long time to repair. So that's still a big uncertainty. And then natural gas. Those plants need to reopen. That takes a few weeks as well. So then if there's a time lag there. So again, everything starts to knock on and build up.
How close are we to seeing inflation expectations becoming de-anchored in places like the UK and Europe that are more sensitive to those energy input prices?
Yes, and I think that's so you can put a timeline on some of these other aspects, whether it's like, for example, fertilizer, that hits food prices next year. That's a 2027 sort of story. Inflation expectations, very difficult to put a timeline on it, because that can start to shift at any point. And you could argue it's more sensitive at the moment because we've gone through a pandemic and a war already. But at the moment, it seems quite well anchored. We haven't felt that impact yet. There are subsidies in different countries. We have an energy price cap here in the UK. Once these subsidies start to unwind, or maybe they are extended, that's another fiscal question we can come back to, then you start to see the impact of it. But I think for now, inflation expectations remain anchored. But as we move into the second half of this year, and you start to see a broader set of disruptions, maybe some constraints on what we can actually access. Is there a chip shortage potentially? We're not seeing any hard evidence there, but there is it's just something else to watch. Then you could start to see consumers thinking, here we go again, and that could be a problem.
We heard from, or the Financial Times was reporting on PIMCO and the CIO talking about potentials for a hike in the US. And you look at the non-farm payroll data that came in strong on Friday. You look at growth at 2% on the most recent GDP data. You see the CapEx spend from AI, and then you see the inflationary story in the US. Is this an economy that we have to start thinking about rate hikes this year? We've been thinking about it in Europe and the UK. Is the US now in that framework?
I think even for the Europe and the UK, for all of them, I think at the moment we are still on the wait and see and on hold for now. I think if we start to see inflation expectations picking up, then yes, everyone's going to start meaningfully thinking about hiking. You could start to see a hike sooner. But I think for now, there is a bit of a trade-off and a balance. US growth is resilient. But the consumer and how the consumer behaves is going to be the main driver, I think, in terms of policy. Because if consumers start to pull back their spending because of higher prices, then that's something to consider as well, which is why we think there's going to be an on-hold, definitely for the UK. We're more confident in the UK and for ECB. But for the Fed as well, we have them on hold for the rest of the year rather than hiking into this because rates are still slightly above neutral. So we're not in the situation we were in a few years ago where inflation happened when rates were very low and they were still, in some countries accommodative. Slightly different environment here, so I think harder to hike.
OK, so a lot of waiting and seeing then from global central banks perhaps lies ahead of us. What about the gilt story then? The front end might move on the Bank of England expectations, but the longer end is where do we look for information about how concerned the gilt market is about politics?
Yes. I think, a lot's already in the price. So we've seen it very volatile but at elevated levels. And I think really it's a case of not just today's speech, but really how everything evolves over the coming weeks. Because it really, as you mentioned earlier in the show, I think it really depends on who is the front runner and how the leadership challenge actually evolves. So there are more gilt-friendly combinations you could think of. I think West Streeting, it sounds like rates investors are more comfortable with a rate streeting, perhaps a Chancellor pick of Yvette Cooper. That combination could be gilt-friendly. You could, on the other hand, have a more balanced ticket where you have Angela Rayner, who is starting to shift her tone in terms of, trying to speak to the markets, trying to make that voice.
I read her statement yesterday, and it said within the fiscal rules at one point.
Everyone has learnt that lesson, the importance of the bond market. So you could have, potentially Rayner and Yvette Cooper, a balanced combination. But yields are going to remain quite elevated in bond markets and curve steep.
Sri, thank you very much indeed for your insights this Monday morning. Sri Kochav-Gindan, Senior Research Economist at Aberdeen. Coming up, Trump's rejection of Iran's latest peace proposal stokes inflation concerns then, as we've been discussing, and weighs on bonds as oil climbs higher. We're going to speak to Pictet Wealth Management's Laureline Renaud-Chatelain. That is next. This is Bloomberg.
Monday morning, how are you doing? Half an hour to go until we start cash trading here in Europe. Futures look a little bit like this. In Europe, actually not much action when it comes to the story. As you can see, we're basically flirting with the flat line. Euro Stoxx 50's up a bit, FTSE's up a bit. All stocks might do well today, CAC's down a bit, but nothing really to kind of draw your eye. You take a look at what has happened overnight in Asia, though. The Kospi rocketing higher yet again. The tech trade is on. Semis continue to push higher. How much of this is hedging? How much of this is what is happening in terms of positioning? Hard to tell at this moment, but you can just see the numbers. Tech up.
Yeah, let's have a look at where we are on the bond markets, because we're going to be watching this development very closely this morning. Of course, oil prices are up by, around 4% earlier on, now up by 3.8% on the Brent price. And we see inflation expectations then on the rise, and that pushes into bond markets where yields are higher. I'm joined to Italy, where we're up by 4 basis points, France up by 3 basis points. We'll wait for the gilt markets to open with the added complexity of domestic politics there. But that political drama in the UK playing into a market that is nervous this morning about inflation and higher yields.
Let's get more details and more analysis right now in terms of the fixed income markets and bring in Laureline Renaud-Chatala, who is fixed income strategist at Pictet Wealth Management. Laureline, good morning. Happy Monday. As we think about longer term scenarios of a continued closure of the Strait of Hormuz and the Saudi Aramco CEO talking about a market that doesn't rewrite until 2027, how much should we think about how much is and what is priced in, where the cap is for yields across global bond markets? How much more pain could there be? How much more of a sell-off could there be across global bond markets as we weigh up the inflation risks?
Good morning. So what we have been looking at is the oil curve. And when you look at it, it's so well in backwardation. And back in 2022, we had a similar picture with what happened with the war with Russia and Ukraine. And at the time, we had 2-year inflation swap rate, for example, in the US, moving up to 5%. And now when we look at the 2-year, we're still at 3%. And the reason why it moved so much higher is because this backwardation actually lasted for months, right? And so the fact that the market is still expecting the Strait of Hormuz to reopen and all this energy flow to normalize means that short-term inflation rate have maybe not priced in the worst scenario, which, as you describe, is a Strait of Hormuz that continues to be shut. And we have as a milestone end of May. And if that happens, you will have severe disruption, demand shortage, and also demand destruction, obviously. And that means that the economic impact will be much more severe in terms of price, but also in terms of economic growth that could dip into negative territory, especially in Europe.
So there's a potential shock here for the bond markets, is what you're articulating. Where across the curve do you want to be focused then in that environment? The short end, you're saying, makes sense at this point.
Yes, exactly. Because when you look at the short end, the yields overall have moved very sharply since the start of the war with Iran. And what we have noticed is that it has been driven both by inflation expectation moving higher and much higher, as I was describing in the 2-year swap rate, for example, in the US at 3%, 4% in Europe, but also by the fact that monetary policy is going to tighten according to market participants. There is 50 basis point hike expected by the ECB, BOE as well, 50 basis point hike. And then we see the Fed moving from market expecting cuts to market expecting slight risk of a hike. So I guess at the short end of the curve, a lot of that is priced in. Now the question is obviously the fact that you will have also a lot less duration risk because we've seen very volatile fixed income markets. So that's also a way to protect ourselves.
Do you think, Laureline, good morning, do you think we'll get all those hikes that are priced into bond markets right now from European central banks, I'm thinking? We just spoke to Sri Kochagovindan, and he was talking about a lot of central banks being in wait-and-see mode, and, you know, the markets have done a lot of tightening on behalf of central banks, perhaps.
Yes, that's definitely something we got from their recent policy meetings. The feeling we have is that if the Strait of Hormuz continues to be shut by June, the next time they will all meet, we have the risk that they feel they have to do an insurance hike simply to avoid second round effect of energy prices feeding into the economy more broadly. So this is not something we have seen. So when you look at the latest inflation data, you see very much that is energy price driven. So it's mostly impacting headline inflation, not much core. Wage growth is still very contained. We saw that with the non-farm payroll in the US on Friday. But this is obviously in everybody's mind. And so they are very worried. And that's something they could do in June, an insurance hike to make sure that you don't have a second round effect if by then the energy flow is not resolved.
Can I ask you about what's going on gilt markets, Laureline, and what you're watching for here? I mean, famously reliance on the kindness of on strangers, it seems, the UK business model. And I wonder whether you're quickly getting up to speed with the various contenders who might be in the running to take over from Keir Starmer, and how much international gilt investors are focused on that.
Yeah, so on our side, to be honest, we have learned the hard way that UK politics is having a massive impact on gilt market. And we see that in part through the term premium. So we're modeling the term premium for all major bond markets. And you see that the 10-year term premium in the UK is the highest among all, around 2%. And this obviously has been going up with the election. And this is something we're watching very closely because in our mind, so yes, when you look at the absolute yield level, you would say, oh, wow, we're 5% almost on the 10-year yield. That could be attractive. But the problem, it's driven by this political premium and we have no control of it, no way to forecast it precisely. And that's why we have this view on the gilt market that we want to stay on the weight duration. Is not something we feel comfortable addressing. Given the uncertainty, it's not something that is linked to economics.
Laureline, good morning. It's Guy. How is your kind of perception of what is happening in global fixed income being shaped by what is happening with the global AI trade?
Yeah, so what we have been looking at overall, I mean, if we look at a multi-asset portfolio, is to say, okay, we underweight fixed income. And we, within the fixed income pocket, we overweight investment-grade corporate bonds. And in an overall portfolio, we prefer, relatively speaking, equity where we are neutral. So I think when you speak about this AI trade, obviously the most upside is in equities. Now, on bond market, what we've seen is some issue from these hyperscalers that have been obviously very well received. So that just putting more issuance, but at this stage is not putting pressure on spreads. So we're comfortable with our overall neutral stance, I would say, especially on Euro and EMIG.
It's interesting that Alphabet is now looking to sell its debt around the world. Does that imply that there is some congestion now within the US credit market, that the US credit market is unable to absorb what we are seeing in terms of the demand coming from the hyperscalers?
I wouldn't say the US market is not able, because when you look at the auction, they were always very well taken, very well bid, many times covered. So it's not a question of lack of demand, but I guess when you see an international company like this, they obviously have some cost and some revenues in other foreign currencies. And obviously when you look at the Euro corporate bond market, it's also a very solid market with lots of liquidity, and yields are obviously lower. So it makes sense to diversify in this sense and to come in markets where you know you will have a lot of appetite. And it's interesting because since the beginning of the year, we have seen around 25% of the issuance of the Euro IG market is actually done by US companies.
Yeah. Starting to spread their bets a little bit. Laureline, great to catch up. Thank you very much indeed for joining us this Monday morning. Laureline Renaud-Chatelain, fixed income strategist, joining us from Pictet Wealth Management. Let's come back to the issue of what is happening in the UK. The Prime Minister, Keir Starmer, making a speech this morning, basically trying to save his premiership, holding back calls, he hopes, for a change in leadership. This in the wake of Labour's sweeping defeat in local elections on Thursday. Starmer set to lay out plans, we understand, to turn the party's fortunes around, including a commitment to take the UK closer to the European Union. However, there are several contenders, as we know, waiting in the wings for a stab at his job. For now, we're joined by Bloomberg UK correspondent Lizzie Burden. How good does this speech have to be?
extra good given the dire results in those local elections last week. Starmer has had many attempted reset moments over the years, and so this is the time not just to change policy, but also to convince the public that actually Labour is delivering as a government. This is what pollsters are saying at the moment, even if when it comes to policy, as you say, there'll be an emphasis on closer ties with the EU. But he needs to read the room. So Starmer was saying that he intends to rule the UK for another 10 years. That seems to ring hollow when, three out of every 5 seats that they were defending in those local elections were lost to Reform or the Greens. When it comes to the markets, though, as you were just discussing with Laureline, you saw gilts rallying on Friday, right?
Yep.
In relief that Starmer is staying. It's not so much cheering Nigel Farage's Reform UK and how well they did. It's the fact that it's Starmer staying at number 10 rather than a more fiscally lax alternative. Let's see if there is a credible leadership challenge this week, because that could change the picture.
And let's think about how fiscally lax others might be. We just talked to Sri Kochgovindan, who was saying that Wes Streeting would be seen by gilt markets as somebody more gilt-friendly, if you like. Angela Rayner referencing sort of fiscal discipline in her statement. We know quite a lot about what she would want to do as leader, because she put out a lengthy statement yesterday. I suppose, what are the markets watching for then today as we weigh up these leadership challenges, potential leadership challenges?
Well, of course, the name that you didn't mention there is Andy Burnham on the screen now, and he's the most popular of the potential replacements for Keir Starmer, but he's not a credible threat at the moment because, of course, he doesn't have a seat in Parliament. There's another non-credible threat, and that's Catherine West, who maybe we haven't heard much about previously, but she's said over the weekend that she would mount a challenge if Starmer doesn't hit that reset button hard enough today. But she's also described herself as a stalking horse, so her purpose more being to open the door to some of the other candidates that you have mentioned.
Yes, because maybe nobody wants to be blamed for starting it.
Yeah.
But they'd be happy if somebody would do that for them.
But the timing around starting it is interesting, because, as Lizzie says, Burnham not in the House at this point in time. So if you start now, you exclude him.
Exactly, because they're so aware that he is the most popular. Does the fact that he's waiting in the wings push Burnham and push Streeting and Rayner faster to launch? Rayner seemingly keeping her options open, telling Starmer, you made a mistake by blocking Burnham previously, but you've got to reset strongly, or else you've got a contest on your hands.
It's going to be an interesting week. Lizzie, thank you very much indeed. Lizzie Burnham. Burnham?
Well, we are from Manchester.
The accent does it. Coming up, the US administration is looking at, quote, all measures that could be taken to lower the price at the pump.
All measures that can be taken to lower the price at the pump and lower the prices for Americans, this administration is in support of. We are constantly looking for different ideas. We've taken a number of actions.
Chris Wright, the US Energy Secretary, speaking to NBC's Meet the Press there after being asked if he would support suspending the federal gas tax. More on the energy story next. This is Bloomberg.
Welcome back. This is the opening trade. 13 minutes then until the start of another equity session and another equity week here in Europe. And the futures picture looks unmoved, really, by the global geopolitics. We've got oil prices higher by 3.5%, and futures are pretty flat here in Europe, flat over in the United States. Let's turn to today's markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore. And Mark, we'll start there, shall we? The fact that the global equity markets seem unmoved, unworried perhaps by another failure to reach a resolution to the war in the Middle East. Bond markets, though, on the other hand, really do seem to care, and we see yields going higher. How do we square this circle?
Yeah, the resilience in European equity markets in particular is quite notable given the jump up in oil prices. But essentially, the AI enthusiasm is kind of so strong that it's kind of adding resilience to other stock markets, that those AI stocks are powering so much further ahead that just, other stocks are having to play catch up and they're not dragging the index down despite that increase in oil prices. But as you mentioned, we're actually seeing a little bit of a disconnect because yields are higher this morning. Yields are reacting to what's happening happening in oil markets. FX is a little bit caught in the middle. I mean, FX has been a bit more of a dead market for a long period of time now. It's not where the excitement is. But we are seeing that disconnect between bonds and equities that isn't probably long-term sustainable, but short-term it just emphasizes that, you know what, from a market's point of view, people have moved on from the Iran conflict until it really takes a big turn again. It doesn't matter the incremental headlines. It's either resolved or major military invasion. But apart from that, we'll just care about the AI trade.
So what about the AI trade? How much longer can the Cosby keep doing what it's doing on a daily basis?
Well, one of the things that's really miraculous is the Cosby's up, 230% since April last year. It's cheaper. It's actually, basically towards the cheapest it's been in history on a forward-looking PE basis. Now, and basically what's happening on the earnings side is much more dramatic than the nominal gains. Now, the Cosby is a unique case where, you've just seen a market that's gone absolutely stellar but continues to get cheaper. But that is what's happening in the AI moment. We're in this AI bubble. We're in the inflation stage. How long will it last? I think a long time still. I think this is a golden era of kind of bullishness around the AI trade. We're going to get volatility from things like the Trump-Xi summit and from Iran, but ultimately until the AI trade collapses, then all those dips are to be bought. When the AI trade collapses, then there'll be tears.
Mark, can you just let us know when that happens, please, just ahead of time? Mark, which parts of the market are most sensitive to the Xi-Trump meeting later this week?
Yeah, sorry, Tom, just to answer your first question, I know it's a little bit, rhetorical, but the idea is actually is the gains are going to be so strong first that you don't have to preempt the turn, and you shouldn't try to preempt the turn. In fact, it's what you should realize is that when it's a negative risk event that is AI focused, that's when you suddenly panic and turn bearish. But you don't need to preempt it. I think as to what happens to the Trump-Xi thing, again, ultimately, as long as AI is fine, I think we'll move on from whatever noise that creates. My one worry into that event is that in the opposite to the Fed put, we have something like the Trump call, which is this idea that when stock markets are at global highs, what he really cares about, that's when he kind of takes the risk of being more hardline in some of his other objectives. So as stocks doing so well into this meeting, I do see a scenario where maybe Trump takes a slightly harder line with Xi, and that creates headline risk. But as long as AI is okay, we're okay.
OK, Mark, thank you very much indeed. Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLive Go on your terminal. Let's get your stocks to watch this Monday and bring in Chloe Melly. Chloe, what are you looking at?
Good morning, Tom. I'm looking at Delivery Hero this morning, which could be moving higher today after its biggest shareholder, Prosus, sold a 5% stake to Aspect Management. And this follows on from an earlier stake sale of 4.5% to Uber. And so for Delivery Hero, this could actually pile a lot of pressure onto the CEO because Aspect has previously a campaign for the CEO to be removed if he doesn't go ahead with selling some units to really boost performance for the company. As we can see, Delivery Hero has not been doing so well lately. We're down about 12%. But this news of this stake sale could actually be moving the stock higher this morning. Moving on to UK stocks, which are definitely in focus as well this morning after the huge losses for Labour in the local elections last week. And we have Keir Starmer that is expected to do a speech today in which he's really expected to emphasise the commitment to bringing the UK closer to the EU now that we're a decade removed from the Brexit vote. And so we should be looking at the FTSE 100. It's been doing pretty well so far this year. It has benefited from its high energy exposure, in particular in that benchmark. But this political instability could feed through into some weakness potentially. And finally, we're looking at MTU Aero, the engines manufacturer, after it was cut to a hold rating by Berenberg, with analysts saying that the higher jet fuel costs that we've been seeing lately could actually undo the growth story for civil engines, for the civil engines market. And so we've seen actually Safran, which is the closest peer to MTU, do a little bit better, and it has been kept to a buy rating by those same Berenberg analysts because it has a bit more resilience to this downturn. And so this dynamic that we can see here, it could continue today as well on the back of that downgrade.
Chloe, thank you very much. Chloe Melly with the latest on some stocks that she is watching. I'll add into the mix Compass, the catering business. They've increased their guidance this morning. They've also increased their dividend. Bloomberg Intelligence saying that this is they're lifting their operating leverage, or their operating leverage is able to deliver this performance for them, which is a positive view on the stock from them. So we'll keep that one in focus amongst all of the other things moving UK assets this morning.
Okay. Oil stocks?
Yeah, oil stocks.
Yeah.
So the FTSE 100, it's still underperformed its European and US counterparts year to date, despite having that energy component. So it's up about 3%. European stocks are up about 3.5%, 3.6% or so. Then you have the gains, of course, for the S&P 500 that are almost double that. And then you've got the KOSPI, which is up about 90% year to date. So 8% of the gains for what we've seen in terms of the US markets, the S&P 500. So oil will be supportive, no doubt, given the higher prices this morning with Brent back above 105 currently.
Yeah. Well, certainly watch that. I noticed on Friday that we saw some real weakness as a result of a JP Morgan note around the defence stocks. I mean, Rheinmetall was one of them, and I know we had a conversation. We had conversations with the defence sector last week in programming, but we saw Rheinmetall, Renk, Hensoldt all down by more than 5% on Friday, and a lot of that seemed to be coming from this JP Morgan note that was quite negative. I wonder if there's another day of trade around that or rethinking of that over the weekend as foreign ministers are gathering this week.
Yeah, how will Europe spend its money and on which stocks and whether or not there is capability to deliver on all of that. The tech trade, what you're not going to see today, though, is a massive tech trade into Europe. It's just, what does Europe do for you in a portfolio right now is a really difficult question, I think.
Well, there's still the energy play around the data centres. So there's still the Siemens energy, which is up 125% or something over the last 12 months. ASML has performed, it's up about 100% over the last 12 months. So Europe still does have some exposure as that capex build-out continues.
Yeah, not compared with Korea.
It's not quite Korea levels.
No, that's where the money seems to be going right now. Anyway, 5 minutes to go. We are pointing to a flattish open. We'll have more details in just a moment. The opening trade in just a moment. This is Bloomberg. OK, we've got a couple of minutes to go until the Monday session is upon us here in Europe. Friday, remember, on the Stock 600, we gapped lower and then basically just went sideways. Similar kind of story in some ways over in the United States. Not much actual intraday volatility being delivered. We were waiting for a weekend that potentially had the chance of delivering some progress on the Gulf. We didn't get that. In fact, we got the opposite. So this morning, we're faced with the scenario of higher oil prices, higher potential inflation, but also a tech trade that just continues to rocket on in Asia, Tom.
Yeah, and those fresh record highs once again for the S&P 500 and the Nasdaq by the close on Friday. And then the read across to the Asian session today with the KOSPI, the last time I checked, up about 4%, to your point. So President Trump slapping down this latest offer, it seems, from the Iranians. European futures, though, pointing to modest gains of a little over 0.1% after the losses of 0.7% last week on Friday. FTSE 100 futures looking to get a little bit more on Brent at around $105 a barrel. Higher, of course, today on the back of the geopolitics, looking to add around 0.3%. DAX futures currently flat at around 24,300 annum.
Tom, let's talk about some of the individual names in focus. We'll keep an eye on Delivery Hero and Prosus. This in connection with the same story. Prosus is selling a 5% stake in Delivery Hero to Aspects Management. This means that the Prosus stake in the business is reduced to about 17%. What does Aspects Management intend with the management of Delivery Hero? That seems to be one of the questions the market will be asking today. MTU Aero is also in focus. Berenberg turning more cautious on the civil aftermarket sector. We'll also watch ASOS. They're expected to get some net sale proceeds on the sale of one of their fulfillment centres to M&S. So we'll watch that one as well, amongst everything else this morning, Guy.
Yeah, plenty of things to factor into this market open. So let's show you some numbers, give you an idea of what is going on. We're not expecting a great deal of movement at the get-go this morning. You've got to price in a higher oil price to equities this morning. You've got to factor in what you see on the inflation story when we get CPI out of the United States. But you've also got a big meeting coming up between Trump and Xi later on this week. How do you think about that? How do you position for that? At the moment, we're going nowhere in a hurry. Stock 600 is barely budging. FTSE 100 is up 0.2%. It'd be interesting to see what the component parts of that look like. Are we separating out the FTSE from domestic politics? That feels like a fair trade. CAC's down by around 0.5%. We'll break that down in a moment and see what is happening there. There's a fair few ex-dividends in the market. Think about that too. The IBEX is flat as a pancake. No movement yet on the DAX or the SMI. But basically, at an index level, we are going nowhere in a hurry this Monday morning, Tom.
Across your sectors, no big surprise that energy is at the top right now in terms of the gainers across your sectors, up 0.9%. 0.4%. Interestingly, tech is there as well. 0.5% is the gain for that sector. Currently the second best performing sector as the numbers shake out. Insurance is on the downside, the biggest loser in your sectors, down 0.9%. Autos also taking a bit of a hit, down 0.7%. But again, top of the list, energy, tech. Interestingly, travel and leisure gaining 0.4% as well. But energy as a sector up 0.9%, Anna.
Yeah, I mean, insurance at the bottom of the basket, and that was the same on Friday, or at least it was one of the worst performing sectors on Friday. So some weakness coming through in the insurance sector. We're watching the rates market, and anything connected with higher yields is certainly going to be in focus for us as we see that trend move around the world. We'd seen here in Europe when we saw bond markets opening up that we've seen a nervousness around higher inflation with yields going higher. That continues to be the case. And it looks as if we've got some movement in the gilt market as expected. We see yields going higher. So we're up by 4.5 basis points at the 10-year. We were down by just over 3 on Friday. So we're kind of where we were at the end of Thursday, just for a bit of context. But across the curve, actually, on the gilt markets, whether you look at 2s or 50s, we're up by 4 basis points across the curve on the UK.
OK. I'm trying to figure out why IAG is up as much as it is this morning. Why we're seeing the travel and leisure sector
the higher oil price, yeah. Curious.
Maybe there's a IAG offering to repurchase convertible bonds due 2028. I don't know. We'll try and get to the bottom of exactly what is happening there. But it's interesting to see that we are seeing basically tech and energy in the same breath, both moving higher, which seems in some ways contradictory.
We haven't seen that
we're getting used to it now.
Right now, yeah. Well, so tech and energy, yes. The travel and leisure is an unusual one. But that is what we're saying. So IAG, to your point, is up 3.4%, one of the best gainers. And then you've got some of the automakers feeling the pressure. Renault is down 2.4%.
Let's get some further analysis of what we're seeing this morning in these markets. Haig Bathgate joins us, CEO of Callanish Capital. Really nice to speak to you, Haig. Thanks for coming in. So we are talking about a disconnect, I suppose, between different asset classes where we're not, equity markets are not flying, but they're also not looking particularly nervous about what's going on in the Middle East. We have oil prices up by another 3% this morning, bouncing again 3%. And bond markets do seem to be paying some attention to what's going on there, and yields a little higher than they were. Do you see this disconnect between asset classes, and does that need to be resolved at some point?
Yeah, I just don't think it can be resolved in the short term, can it? I mean, there's just so many competing forces that the market's trying to grapple with, and some of them are interrelated. And of course, it's not just that we've had quite a high market coming into this. We've had earnings seasons to support it, but now we've got the prospect as well of, some very large AI IPOs coming later this year. So I think there's a kind of stock overhang issue as well, which is starting to feed into the market, which is why probably we've not seen as much progress on US tech despite the bumper results. And it's now sort of feeding into places like, South Korea, as we've seen, that's been very strong. OK, so some of those investors who might be keen to increase their exposures to tech, they're saying, well, hang on, we're going to wait for these big IPOs. Yeah. We're going to put money into those, or at least not put money into other things right now and wait to see how that plays out. Is that where we're at? They're not nervous about that. You referred to it in your notes, that CapEx curse. Yeah, absolutely. And look, there's also the chance, you can see Trump's approval ratings are very low at the moment. So we're going to come up to the midterms. He's probably going to get trounced, probably not in quite as major a fashion as we saw on Friday with Keir Starmer. But if we start to move towards more of a democratically leaning government and people are starting to think about that, then the whole regulation of tech and so on is very different than under the current regime as well. So I think it's just incredibly difficult to forecast things. So you don't really want to be playing the hero in these things.
Right.
Where are you finding value at this point, particularly when it comes to AI? Are there parts of that trade that are looking mispriced that you can take advantage of?
So we're looking at second order effects because obviously this is real capex. So you're trying to see where that's going to feed into. Is it chip makers? Is it storage makers? But that's real money that's been raised, which is being deployed, and I think that's why we're seeing quite a lot of strength in areas like the COPs at the moment. But also we quite like some of the kind of traditional hyperscalers. I mean, again, if we go into a more mixed political environment in the US, someone like Microsoft's probably much better at dealing with a democratically leaning government than say some of the XAI would be, for example. So you've got lower political risk in some of those plays as well, and also just short dated yield. So you roll down the yield curve when rates are falling, but you roll up in this environment. So floating rate type exposure hedges you against that sort of upside rate risk. and you're getting paid a pretty healthy yield. One of your earlier commentators was saying, it's not like the early 2020s when rates were really low, so you can just sort of harvest this yield at the moment as well.
What's the best insurance against a prolonged energy shock?
So yeah, look, inflation-linked bonds ultimately are going to be a good hedge against that. I think also areas like trend following at the moment are quite attractive. In this kind of environment, we don't know whether we're going to get a sustained, or which direction we're going to get a sustained trend, but we're probably going to get a trend in one way or the other. So again, there's plenty of areas to store cash and protect, I think.
You sound very sort of calm on the tech trade. Just figure out who's going to be next, and we'll kind of put some money to work there. How much temptation is there? You must feel pressure to chase what you're seeing in terms of some of the numbers.
Yeah, so the way we typically do that is through the indices, because you don't have the emotion of trying to get involved in one stock or pick the winner. You want to try and get that sort of, the tide rising and pushing up all the boats in the harbour type analogy. But yeah, I mean, it's difficult. I know it's much more exciting to invest in tech than it is in some of the traditional asset classes, kind of insurance companies and so on as well. So there's always the story that makes these things more exciting. But yeah, look, I think the stock overhang issue that we could have later this year is very, very significant. So that's why we're pretty cautious on some of these things, other than the traditional type companies.
So Tom asked you the question about how do you protect your portfolio against kind of the energy shock. How do you protect against wild swings in tech? You've got to have some exposure to it, but you're signalling that maybe you need to have some caution when you think about it as well, maybe further down the road. So how do you build a portfolio that gives you that optionality?
Yeah, so the thing we're worried about with tech is the idiosyncratic risk. So if you back something like Anthropic and you're wrong, we know you can get, you can lose 60-70% of your money in the blink of an eye. So what we're trying to do is just get the beta of the asset class, and that's the best way to protect against it. That way we can get the uptick. And of course, I mean, some of these companies are on pretty premium ratings. But if you look at something like Microsoft now, I think it's down on a sort of forward P ratio of 24, because it keeps beating its expectations by a huge amount, and the share prices don't re-rate at all. So there are some lower risk areas of tech, even though that's a bit of an oxymoron. But because obviously if something gets flushed out, they'll all correct. But I think if you look at things like Alphabet, Microsoft, they're producing a lot of cash as well. So that's where you can get some protection in that environment.
When you think about the AI phenomenon, Haig, and where the profits are going to be generated, we talk about the sort of narrowness of the rally that we see in the States. The Kospi clearly doing really well at the moment from the memory chips there. Are we going to end up in a situation where the profits are more are held by a smaller number of companies, or is this going to be broad enough that this is going to be? I'm trying to think of macro read across, I suppose, from the AI trade.
Yeah, I mean, look, we see with all of these sort of technologies, there's two or three, prominent players that establish themselves over time, and at the moment we don't know which one's going to be the prominent player. So yeah, look, I think we have to see how it's monetized. I mean, the big surprise, despite all the noise, is there has been a lot of monetization. So everybody in the last reporting season was worried about the capex, and then now we're starting to see the monetization. I mean, the rate that Anthropic are, through quite good marketing as well, are monetizing this is pretty impressive. But of course, we all read the same stuff. The big thing is how do they all, it's an arms race, and how do they all gain access to the processing power to allow the models to move forward, unless they can gain access to data centres, and then it's coming down to the whole energy supply point again.
How are you feeling about the UK right now as an investment destination, UK assets?
Yeah, I mean, the UK, sadly, is not that relevant in the overall scheme of things. When you look at MSCI World, it's, prior to the GFC was, the UK index was about 11% of global market cap. Now it's 3.5% and falling pretty rapidly as well. So if you don't call the UK right, it doesn't really make that much difference. Again, you were talking about political risk here. If Keir Starmer is deposed, which I don't think he will if you've read Get In by Patrick Maguire. But if he is, and it's a more left-leaning government, and you've got Ed Miliband, who's quite openly talking about, one-off taxes for UK companies, then, there's just a lot of risk there that you don't really need to take.
Just, the UK takes me towards the kind of the rate hike story. If we get rate hikes, do you think that, to your point about kind of what you're seeing in terms of just rolling the curve. Is there a danger that we get rate hikes now that actually what it does is precipitate rate cuts? Because actually the economy kind of screams lower at that point. And you've got some of the factors you're referencing as well. But you can kind of think about this more broadly. So how clear are you on that trade? How certain are you on that trade? How quickly could it reverse if suddenly we get 2 rate hikes out of the ECB and then the economy stalls and then you're talking about maybe aggressive rate cuts in 27?
Yeah. I mean, look, again, I mean, that could all obviously happen quite quickly. I think there's a couple of factors with the UK as well. The fiscal position wasn't great coming into this. No. We know that we've got a productivity problem over here.
Yep.
You've got 25% of the outstanding debt is index linked as well. So that the cost of servicing that is going up all the time. And then you've got an increasingly likely left-leaning government who's going to want to redistribute more. And we saw when we had the Tory government how hard it is to cut spending. It's even more troublesome, obviously, in this kind of environment. So the fiscal risk of, some sort of problem at the long end part of the UK yield curve, I think, far outweighs any return potential.
That's interesting you've got there.
And you can play the same theme in US.
I was about to say, does that get replicated elsewhere? Yeah. Nice to see you. Thank you very much for stopping by to see us. Callanish Capital CEO Haig Bathgate joining us here on set. Let's take a look at the call 6 this morning and show you what is going on. Schneider, AXA, Swiss Life, Veolia, all going XD today, so just bear that in mind when you look at the screen in front of you. Defence stocks, to Anna's point earlier, are lower once again. ASML, though, the chip space, is having another good day. Let's deal with the details of the session and some of the single stock stories we are watching. Close here with all of that.
Good morning, guys. Delivery Hero is up quite strongly this morning after Prosus sold a 5% stake in the company to Aspects Management. So for Prosus, this is part of the strategy of selling down its stake in Delivery Hero as part of its acquisition of Just Eat Takeaway. And for Delivery Hero, this could actually mean quite a lot of pressure on the company and on the CEO to sell down units, to sell down assets, and really to boost performance, because Aspects Management has previously campaigned to have the CEO removed if that doesn't happen. And so this stake sale is being received quite warmly by the market, and we're up more than 6% this morning. We are also in the green for Compass, the catering company, after it raised its guidance after really, really strong first half results. It's really benefiting from what it said was really accelerating demand for outsourced cleaning and catering services across a range of industry, and we are up more than 4% this morning. We're also in the green for BP after it was upgraded by RBC analysts, with the analysts saying that the current commodity price environment actually creates a really good opportunity for BP to deleverage and restore its financial health. And so we're up about 1.6% for that company. Moving on to Sleep Cycle, which is actually a smaller company that makes an intelligent alarm clock that tracks and analyzes sleep patterns and sleep phases. And it just got an offer from a private equity company called Alta. And so we're up super, super strongly this morning, about 45% for that small company. And finally, ASOS is selling its fulfillment center to M&S for net proceeds of £66 million. And we are seeing that actually boost the stock quite a lot this morning, up almost 12% on the back of that.
Thank you very much indeed. I was just Googling Sleep Cycle because it sounds like with an alarm that goes off at
slightly
4:45 in the morning,
this,
this could be beneficial to us. There you go, tracking your sleep.
Yeah, but you're not allowed to wait for the sun.
How much more data do we need?
I can tell you every morning how I've slept.
Without all the data points?
Yeah, getting up quite early. Not very well.
Coming up, we're going to speak probably of other matters to the Foreign Minister of Lithuania as NATO allies brace for President Trump potentially to pull more troops from Europe. That is next. This is Bloomberg.
Welcome back. This is the opening trade, 18 minutes into Monday's session. And on the face of it, European equity markets seem quite unfazed by developments in the Middle East, up by 0.1% on the stocks Europe 600. US stock futures have been looking flat, really. Flat to negative, though, right now. But actually, if you dig into the detail, we do have energy stocks moving higher. So that's partly why Europe is cushioned from the negativity of higher oil prices, Tom, because we actually see some benefit in the very short term for the energy stocks.
Yeah, that is coming through in the session today. Let's get a deeper dive on what's happening in terms of the defence space right now, because Bloomberg has learned that US allies in Europe anticipate that President Trump will withdraw more forces from the continent after he announced, of course, that he would pull troops out of Germany. For more, let's bring in Oliver Crook, our chief Europe correspondent, who is standing by with a guest. Ollie.
Yeah, that's right, Tom. We're here at the European Council where foreign ministers from Europe will be joined by the Ukrainians today and also the Canadians, who are making much more of an appearance at these meetings of late. And we're very pleased to be joined by the Lithuanian foreign minister, Minister Budrys. Thank you so much as you head into this meeting. I'd love to get your perspective now. As of this weekend, we have a new government in Hungary. Thinking about the path forward for Ukraine, how does that change things in the sanctions package? Could we see a full ban on maritime services?
It already changed the situation in Europe. Now we are already fast with the decisions that were delayed because of the Hungarian veto. So Ukraine support loan, that political okay was already given. So now it's the technical deliberations, and we are looking forward for June to be the month when the first tranche will reach Ukraine. The second big package that was really important, that was the sanctions, 20 sanctions package. So we passed this one, and Lithuania calls for already 21st package. We are offering Rosatom, Lukoil to be sanctioned, because they cannot be the exemption, and especially when Lukoil is sanctioned by United States. This is ridiculous that we are not doing this. And of course, moving forward with the shadow fleet and with the maritime service ban, that is constantly our position. We understand that there are some limitations, and of course, it would be better to do within the G7 group. But Europe has to show leadership. What else?
And thinking about that shadow ban, the fleet, the ban of the shadow fleet, a lot of the crude oil that is coming from Russia is flowing through the Baltic Sea. Do you think it's realistic, and do you think the Europeans have enough sort of strength to kind of crack down on these ships?
We had the debate already about it. Look at the progress that we've done in 1 year. The number of vessels that we sanctioned during this year. So this is the largest number. The pressure that we put on the vessels, on the quality of the crews and of the technical equipment, it was also increased. We make a difference, and we increase the cost for Russians. So this is how it would work with the maritime services ban. So we have to do it. Of course, we hear also the concerns of some of the countries that it would be better to do in the broader group of countries, because that would reduce some of the risks. I understand it. That's why we have to continue working with the United States also on it.
And now with the United States much less engaged in the conflict in Ukraine, there's some questions and some conversations in Europe about engaging with Russia on some meaningful level. We've heard from President Costa saying that the Europeans are going to sort of unite a position on this. What is your position on this? We heard from the Russians, from Vladimir Putin this weekend, saying that Gerhard Schröder, the former Chancellor of Germany, might be a good go-between. Do you think that's a realistic proposal?
Once again, we are falling into the trap of Putin. He's just hijacking our debate and turning it into what is favorable to him. We should stop it and just leave it to the side, the candidates. We should start from the very beginning, from the basics. What will be our demands? What we need and want from Russia to get out from Ukraine? That is only number one. Also to get rid of all the weapons that they deployed after the full-scale invasion in Belarus and other places. Also, we have to talk about the sticks in our hands, about the strong leverage, because no one expects that it's about the rhetoric art in the dialogue and the debate and discussions and negotiations with Russia. No, it's about the strength also in our hands. And once again, what's the goal? What's the end state? What will be our strategy? And we are not discussing these things. We are jumping into some tiny details that make no difference. Who will debate if he or she will have these strong instruments in the hands?
And thinking about not Europe's role necessarily in Iran, but the consequence of the Iranian war on Europe, there's been this threat by the United States to pull out 5,000 troops from Germany, potentially more to come. Would you like to see those troops moved, if possible, to Lithuania? Is that a conversation you're having with the United States?
We want to have United States troops in Europe. That's full stop. And of course, we want these numbers to be increased. Where they have to be deployed, this is also the discussion within the NATO among the allies. From our position, and that was long months and already years that we said that they had to be at the front line. The deterrence effect is the most, is the biggest there. We already proposed the United States, and that was a while ago already, to increase our host nation support package to U.S. troops that are already deployed in Lithuania. What concerns the housing, what concerns the training field areas, and also our financial package that we are providing. So we are providing the state-of-the-art conditions that are there, and we are ready to expand it. And I hope that U.S. will remain in Europe at this scale, what they are now.
And thinking also about another consequence, which is weapons deliveries to Europe from the United States. We've heard a lot of reports about delays or that they've been put on pause. Can you give us an update in terms of what we're getting and what we're not getting from the United States in Lithuania, but also for Ukraine?
There are some categories of weaponry that we are procuring from United States that delivery dates are delayed. This is because of the high demand now, not only within the Europe but also globally. And this is one of the reasons why we have to talk also about the ramping up our defense industry capacities also in Europe. And also it has to be done in EU. And I see this as the very important topic for our NATO discussions in the upcoming Ankara summit. That will be the topic number one, how we are increasing the production of defense industry, because this is something that my country feels on our skin.
And do you think that there's progress being made on those conversations across those pan-European programs? And I want to talk more specifically about joint debt, because now we're talking about potential stimulus as a consequence of the energy crisis, trying to basically reduce the cost for that. That is going to put massive fiscal strain. Do you think that there is a reanimating of the debate on Eurobonds for defense?
First of all, we have to review what we are spending on our national defense, but in our budgets for the defense purposes, because that's what we pledged back in Hague summit. So before Ankara summit, I'm really looking forward to see the increase in the defense spending, and we cannot allow the joint debt being as the excuse to avoid the discussion about our national spending. And when I hear those voices about European autonomy, the paradox is that the louder the voices are about the autonomy, the less the defense spending is on the table. We have to stop this trend.
Well, thank you very much, Minister Budrys, for your time here at the European Council. Going into that, of course, trying to make sense of the sort of repercussions of the war in Iran, and of course now the path forward with a new government in Hungary as of this weekend.
Oliver Crook on the ground for us with that important interview. Thank you very much indeed. So pretty strong views there in terms of, well, number one, the need for US troops to remain in Europe and preferably nearer the front line, and talking about the support package that nation, Lithuania, is offering to the US to provide that. The shortages of weapons as well, as of course the US prioritises Iran, and the need again for defence spending, and what the cost of that is in terms of the payoff of having to focus more on defence spending versus maybe some other programmes.
It was very interesting that Gordon Brown, former Prime Minister, was talked about at the weekend, being brought back into government in some form to represent the UK. And he's going to have a bit of an influence on defence, it would seem, where he's going to be taking initiatives around Europe that the UK has. And one of the ideas he's had is to be able to increase spending on defence without it counting towards the fiscal rules. So I wonder if that is something that we talk more about here in the UK in the days and weeks to come.
And how does the bond market feel about that? Not very good, I would have thought. But we'll see. We'll see whether that idea gets an outing and whether or not it gets shot down by the bond market. That's the challenge now.
Yep.
Coming up, energy prices then spiking as Trump rejects Iran's latest response. We're going to get more context. Stay with us. This is Bloomberg. This is the opening trade. We are 30 minutes into today's session. Happy Monday. Futures are pointed higher for Europe. That is not what is transpiring right now. European benchmark currently flat. There's a little bit of caution. President Trump slapping down this potential offer from the Iranians. So we continue to focus on what is happening in terms of the Iran-US conflict, of course. You've got the likes of energy and tech on the upside, and you've got industrials and defence on the downside. The DAX then down just 0.1%. Heavier losses over in France, with the CAC current dropping 48 points. Here in the UK, a bit of support coming through from energy and higher oil prices, up 0.2% on the FTSE 100. Guy, what are you seeing?
OK, let's get into the internals. 263 up, 324 down. So a slight bias to the downside, but I wouldn't say that is a convincing bias. Volume is muted. We're returning to that as a narrative here in Europe. Looking for a little bit of a catalyst this Monday morning, it feels like. Reasonably balanced market. So let's dig into the single stocks and just show you what is happening here. I think Novo's got an upgrade at Citi this morning. That is why it is driving higher. The Compass results actually fairly favourable. We're up by 2.75 in the catering space. And Delivery Hero, we've talked a lot about that with the Prosus stake sale, actually up 5% this morning. So some positive stories out there. Let's talk about where we see some downside. The defence names continue to lag this morning. Rheinmetall is down by 3.35. Airbus off a little bit as well. LVMH in the luxury space also giving back some ground. So there's some heavyweight names out there that are under a little bit of pressure. Anna.
Yeah, some of that weighing on the CAC 40 then, as Tom was saying. Let's focus in on some of the other stories we've been telling this morning. The Wall Street Journal is reporting that Apollo Global Management has been holding talks to sell Midcap Financial Investment, its publicly listed business development company, or BDC. The paper says that the talks are ongoing and there is no guarantee they will result in a deal for the fund, which Apollo values at roughly $3 billion. The UK Prime Minister Keir Starmer will make a speech today to try to save his premiership and hold back calls for a change in leadership. This in the wake of Labour's sweeping losses in local elections at the end of last week. Prime Minister Starmer is set to lay out a plan to turn the party's fortunes around, including a commitment to take the UK closer to the European Union. President Donald Trump and Iran have rejected each other's latest peace proposals. Trump saying in a social media post the response from Iran was, quote, totally unacceptable. The Wall Street Journal reported that Iran offered to transfer some of its stockpile of highly enriched uranium to a third country, but rejected the idea of dismantling its nuclear facilities. The country's semi-official news agency, that is Tasnim, says Iran disputes this report. Tom.
OK, well, let's stay on that story because Saudi Aramco's boss has warned of a long disruption to oil markets from the near closure of the Strait of Hormuz. He made the comments as the oil giant reported a jump in profit as it benefited from higher oil prices and its ability to redirect exports via a pipeline bypassing the vital waterway. For more, we're joined by Anthony De Paula, our Middle East energy reporter. What more, Anthony, good morning. What more did Saudi Aramco's CEO have to say about the disruption and what it could mean longer term for the energy sector?
Good morning, Tom. Yeah, as you said, Aramco mentioned that it's still exporting. It's still using that key pipeline that goes across the country. But that is a diversion from its normal route, which is out through the Persian Gulf. All of its main fields are on that eastern coast, in the deserts there, or even in the offshore fields. And that oil is produced and sent from that massive export terminal at Ras Tanura on the Gulf through the Strait of Hormuz. That's been closed off. So Aramco is able to do about 70% of its normal exports at most via that pipeline to the Red Sea to the west. But the interesting thing about the Aramco CEO's comments is that he's saying even if we get Hormuz open now, it's going to take a number of months before the oil market can rebalance, before those crude exports can get back on vessels, get to refineries, before the Gulf refineries can start producing that key jet fuel and diesel that's going to be needed, particularly in places like Europe when they get into summer travel period this year. And that's just coming up in next month. So he's saying a couple more months before things get back to normal if we open now. If we don't open now, that pushes back into 2027, into next year. So that's a much longer time horizon, I think, than markets and then for sure President Trump would be looking at to get the markets back into shape.
Yeah. And Anthony, what story do we see in the numbers from Aramco? We got those numbers over the weekend. So along with the commentary about the Strait of Hormuz, we also got the numbers from them. Is this a story of vulnerability because, of course, of the closure of the Strait? Or is it a story of resilience because they've got that east-west pipeline? What's the story coming out from these numbers?
Yeah, well, resilience is a word that pops up in the statements and in the presentation slides that Aramco's put out between yesterday and today. So we're waiting for a call later this afternoon with analysts in which they'll go through some of those numbers. But, you know, clearly we see that big jump, a 26% increase in the adjusted net income. That clearly shows some ability to adapt and to stay in the game. And that's largely on those exports, as we mentioned, by the pipeline across country. So lower volumes, but at higher prices. So prices surged in March. They were much higher in March than they were, just the 2 months prior. The quarterly average versus the quarterly average a year earlier is not that much different. But it's that surge in March plus the surge in the price of products, which Aramco is still exporting from the West. So that's what's really helping the company, Anna.
Anthony De Paula, thank you very much indeed, our Middle East energy reporter, with the latest details and commentary from Saudi Aramco, of course, as the region continues to contend with a standoff between the US and Iran. For more analysis, we're joined by Emily Ashford, Head of Energy Research at Standard Chartered. Emily, Good morning. Saudi Aramco CEO then talking about an energy shock that could continue, at least a market that doesn't normalise potentially until 2027. Is that what we're considering? Is that what we're thinking about now? Is this an inflation shock for 2027 as well as the back end of this year?
Hi, yeah. We've seen, I think, an interesting development over the past 24 hours that's maybe tilting market expectations back towards a more prolonged conflict. So I think there'd been expectation that some of the diplomatic channels were going to produce some more positive results. But after the US rejected Iran's response to its proposal, I think we're still back in that stalemate situation. And every day, every week that passes is more barrels lost from the market. We do still have a fragile ceasefire in place, but it's certainly being tested. And all of the situation doesn't necessarily look the best setup for us to achieve a diplomatic breakthrough. But I think we do see signals still that de-escalation channels do remain open, and there's still third-party mediation continuing, even if both sides are continuing to push for those maximalist demands. We still need to see the first step, though, in a sort of trust-building exercise between the two sides. That's what we need to achieve before we actually are able to negotiate some of these more complex issues, such as Iran's nuclear facilities and the US demands there.
Emily, how are you thinking about the pricing right now? 105 on Brent, little under 105 in the session today. So, yes, it's popped up. But in the context of what we've seen since the start of the conflict, it's not looking screamingly high. Is this about more US oil in the market? Is it about the US cutting its own imports? Is it about Brazil playing a bigger role? Does the pricing make sense, given that continued uncertainty that you've just highlighted?
Yeah, Brent seems to have found a sort of uneasy equilibrium at the moment between 100 and 105. And what's interesting is that its reaction to headlines has been notably dampened over the past few days. Perhaps where we've seen some more interesting moves is in the cost of real world cargoes. So we have seen an easing in the premiums for some of those North Sea grades, which have been falling back towards pre-war levels. And prices, although they still indicate a tight market, are returning maybe towards a more normal range. We have seen some of the official selling prices remaining historically high. But we've had a reduction month on month, for example, in Saudi Aramco's official selling price. It could be that buyers thought that we would have a deal soon, and so they've been holding off in paying these high elevated prices for cargoes, just about getting by, at least in the short term. So alongside the inventory drawdowns we've had, reduced refinery run rates and adjustments to maintenance schedules, and as you mentioned, supplies from alternative producers, with the most recent US data showing a very sharp increase in its exports, improved exports from Brazil, and China also reducing its imports. I think the issue will be, when can these purchases no longer be deferred? So at the moment, this is likely a temporary blip, and we're going to see a return to some higher prices for physical cargoes in the future.
Emily, what is your assessment of inventories? They have played a big part here. How do they stand currently?
Yeah, some of the product inventories are remaining surprisingly good. I've been keeping an eye on jet fuel in particular. That's been one of the key topics that we've been discussing. And if you look at US jet fuel inventories, actually they're above seasonal averages. So I think some of these movements are still to play out in the data. As we start seeing not only those strategic reserve releases being added to the market, but then some of those product inventories starting to move around. But for now, not catastrophically bad. I still think, though, if we are assuming maybe 1 billion barrels of total supply off the market since the start of the conflict, then there is no way that inventories will remain as strong as they have been at the moment.
Emily, when we look at the meeting between Xi and Trump later on this week, what are energy markets going to be watching for? I'm thinking about the fact that China does buy product from Iran, but China also went into this conflict with arguably quite high levels of reserves. So what will you be watching for?
Yeah, I think all eyes on the meeting between Presidents Xi and Trump, and certainly we expect Trump to take this opportunity to talk about Iran. We've also seen some increased pressure from the US Treasury recently, using further measures to try and deter any purchases of Iranian crude, expanding its focus of sanctions to specific refiners, logistics, including shipping firms, any vessels alleged to be part of this shadow fleet. But we think enforcement there is likely to start hinging increasingly on secondary sanctions. That could result in some of the buyers of Iranian crude being forced out of the market, reducing overall purchases, but also tightening the sour crude market, which is already constrained by the US blockade. The most obvious substitute still remains to be Russian Urals. And we'd also start to expect maybe reduced refinery runs from China's teapot refineries if either its feedstocks or financing start to be restricted. But I think all eyes on that meeting later this week.
Emily, can I just take you back to the product market, which you were talking about just a moment ago with relation to jet fuel? What's the story on diesel? Because the line between diesel and inflation is pretty straightforward.
Yeah, some of the diesel cracks have been the highest price movers that we've seen since the start of the conflict. And obviously, as you said, diesel is so integral to the entire economic complex. We have it from vehicles to transportation and logistics. So diesel has been particularly key. It's going to be very interesting, in my view, to see how the behaviour around diesel consumption adjusts over the next couple of months. Again, for now, we are relatively comfortable, but high prices always adjust behaviour. So that's where I expect to see adjustments coming soon.
Yeah, since you've got a chart on the screen showing a big pickup in diesel, but inflation in the United States yet to really respond. Those two things do tend to track each other. Emily, thank you very much indeed. Emily Ashford, Head of Energy Research, joining us from Standard Chartered. Coming up, Beijing confirming the Trump-Xi summit is going ahead. It was actually a question as to whether or not that was going to happen. What is at stake? We're going to find out next. This is Bloomberg.
Welcome back. This is the opening trade. Now, we have a big focus this week, of course, on what's going on in China. China has confirmed that President Trump will officially visit the country this week. Our chief North Asia correspondent, Stephen Engel, looks at what's at stake.
State visits to China of this magnitude usually take months of preparation, countless hours of back-channel horse trading, and optics planned to the most precise detail. By many accounts, that hasn't happened ahead of this summit, especially with Washington's attention squarely on the war with Iran. There's palpable concern here in Beijing that this two-day affair could be splashed with far too much spontaneity for China's liking.
They want no risk, they want a no-thrill summit, and they want deliverables on both sides clearly defined. How do you do that with an administration that is not engaging in the traditional way that U.S. administrations have engaged their counterparts in China?
Is there a clear China policy, do you think, in the White House?
No, I don't think there is.
The issues are endless. Front and center could be the war in Iran.
Iran is the world's largest state sponsor of terrorism, and anyone who's buying oil from Iran is contributing to that. We're looking for stability with China. We don't want this to be something that derails the broader relationship or any agreements that might come out of our meeting in Beijing.
Also, will the two leaders solidify a more lasting trade agreement? Boeing airplanes, soybeans, rare earths, perhaps even the most advanced AI chips could all be up for discussion.
The fact that the U.S. is hosting G20 and China is hosting APEC, which means their ministers are running around in each other's big cities all year long, and the two leaders will meet in these multilateral environments, is also very positive.
But is Taiwan on the table? Xi may want certain assurances from Trump with an arms package to the island pending in D.C. The two sides may end up playing it safe, announcing easier deliverables like better people-to-people exchanges or even visa-free travel. A long shot for sure, but China has implemented that with many more countries of late as a diplomatic outreach and a way to boost a sluggish economy. As far as the services sector goes, there's absolutely no question at all that the domestic tourism market is absolutely booming. Keep in mind, this summit is on China's turf, begging the question, has the Trump White House readied its most effective away game plan?
They're putting a lot of stock on the personal diplomacy between President Trump and President Xi. It's not a long-term strategy. It's a short-term strategy.
Stephen Engel, Bloomberg News, Beijing.
For more, we're joined now by Bloomberg's Rebecca Chung-Wilkins, who's in Singapore for us and can provide us with some analysis of what to expect. Rebecca, great to have you on the programme. Thanks very much for being with us. I wonder what you think or what markets should be focused on in terms of success or failure here. If we just get headlines about soybeans, I wonder if the markets might be disappointed. I mean, what are you going to be looking for?
Well, look, I do think there is relatively modest and moderate aspirations about this meeting. I don't think that expectations for a breakthrough are high. I think the one area where perhaps markets are expecting something and may well be disappointed is going to be over the Iran war issue. We are expecting US officials to press Beijing on that front. And this is the precise issue, in fact, that Beijing was cautious about. One of the reasons that we reported earlier that officials were sort of somewhat anxious was the timing of this summit coming before any kind of resolution on Iran. And we have had state media on the Chinese side as well expressing that it's unfair for the US and for the rest of the world and other countries to be overly reliant on Beijing playing a big role there. So that's sort of one area where I think we may see markets somewhat getting ahead of itself and somewhat being disappointed. It is such a thorny issue. But elsewhere, of course, a whole host of other problems that are coming up on the docket, as you say. There's a whole issue of AI and the tech race that may come up. We also are expecting potentially something on Taiwan. We're expecting the US to raise it, and it is an issue that Beijing has really taken umbrage with, particularly those sales of weapons by the US to Taiwan. Beijing, on its part, might be pressing the US to make some kind of statement that it explicitly opposes independence, for example. And then, of course, to your point on soybeans, agriculture, yes, there is this sort of low-hanging fruit that may come up. We may also see some sort of movement on people-to-people discussions that my colleague Stephen Engel mentioned, perhaps. But I think overall there is a feeling, and I would say particularly from Asian nations as well, that have been so hard hit the fallout of the Iran war, is really just a stabilization of ties may be good enough, at least for some of the geopolitical actors in this part of the world.
Rebecca, the Chinese economy is not in good shape. How does that change the calculus from Beijing's point of view?
So I think there's sort of two elements. On the one hand, yes, there is this growing pressure in China because of that economic pressure that we're seeing. I mean, the domestic consumption, there is still some sort of weakness there, even though we are seeing, of course, some amount of inflation showing through, ending the sort of the deflationary streak that we've seen. But there are those price pressures that people feel on the ground as well. But of course, on the other hand, we do see that the fortress economy, the so-called fortress economy, well, it may be showing up some cracks, but ultimately it may still have room to kind of hold up. I think longer term, that's really where the issue starts to sort of come to the fore. And I would say that, you know, when it comes to the Iran war, the pressures that are showing through in Beijing, it's not just the case that Beijing doesn't necessarily want to get involved or doesn't want to be seen to be getting involved. It does have a massive exposure, for example, to the rest of the Middle East. It has something like $270 billion in investments and construction projects across the Middle East, including several Gulf nations. So it's really a delicate balance here for China. It certainly is investing in bringing about an end to a conflict. It is not the case that it simply, for example, sides with Iran, as important as Iran is, of course, in the relationship to China. There is an enormous amount at stake for Beijing directly in the region. It has had several projects, for example, in Dubai and elsewhere, that have been directly impacted impacted and affected. But there is also this hesitance that we see, as we often do, with officials being kind of cautious about the unpredictability, not wanting to become very publicly entangled in a negotiation that then ends in failure. We often see China sort of working behind the scenes and somewhat privately and somewhat perhaps sort of almost secretively, and then wanting to come out with a big display to show its success. So I would say even if we don't see an enormous amount of explicit progress, or we don't see sort of big promises from Beijing, doesn't necessarily indicate that there is some sort of progress going on behind the scenes. But Beijing tends to be very tentative in how it likes to message these things.
OK, Rebecca, thank you very much indeed. Sending us up very nicely in terms of what to think about, in terms of the priorities for both sides ahead of that meeting between the two leaders. Rebecca Chung-Wilkins joining us out of Singapore. Let's look at what else we are watching throughout the week then. Later today, we're going to hear from the UK Prime Minister on what's deemed as a crucial speech. We'll be marking that for you, of course, potential market consequences. And on Tuesday, Germany's ZEW survey will be breaking. We'll also get US inflation data with CPI. On Wednesday, both the IEA and OPEC monthly oil market reports will drop, so more detail there on what's happening in terms of the oil market and the impacts, plus euro area first quarter GDP and US producer prices. And on Thursday, President Trump, as we've been discussing, is expected to visit China for that meeting. We'll get UK first quarter GDP as well. On Friday, it's Jerome Powell's term as Fed chair ending officially on Friday.
There's a lot in there. Busy week coming up. CPI stands out for me in terms of what we're going to see over in the United States as things to watch. Let's get a take on what is happening with these markets. Bloomberg MLI's Moana Cunningham joining us around the table to wrap things up. Oil up. Bond market doesn't like it.
Not at all, no. We're having, I guess, another sense of Monday morning deja vu, I think, with things having turned sour on the US-Iran front. It's hard to see exactly where things are going to go from here, but we've got Brent Crude back up around $105 a barrel this morning, and that is sending bonds down across the globe this morning.
Yeah, and the situation in the UK even more so because of politics layered on top.
Yes. It's hard to extrapolate exactly how much of the impact on UK bonds is coming from political drama versus international, but UK bonds are underperforming those elsewhere quite substantially this morning. That is obviously after they outperformed on Friday, perhaps surprisingly, given that the election results were coming through showing heavy blows for Labour, but there wasn't really any clear, credible challenge coming forward. So I think there was a bit of relief there, which may have been premature.
Moana, thank you very much indeed. Bloomberg MLI's Moana Cunningham. Just flagging for you, we're going to be hearing from JP Morgan Chase CEO Jamie Dimon, who's going to be joining Francine Lacqua at the bank's Global Markets Conference in Europe. Stay with Bloomberg for that interview, 2:45 p.m. London time. The Pulse is up next. This is Bloomberg.